Welcome to The Explainer. I am so incredibly excited you're here today because we are going to unpack a truly fascinating and honestly kind of terrifying piece of financial history. Today, we're looking at the architects of ruin. We're going to explore exactly how highly educated, highly compensated leaders managed to completely bring down massive, billion-dollar financial empires. It's a wild story of greed, immense risk, and unbelievable collapse. Think about it for a second. How in the world do these executives, graduates from elite places like Harvard, Stanford, and Wharton, guys making tens of millions of dollars every single year, trigger such catastrophic banking failures? You'd think that with the absolute best education in the world and literally every resource at their fingertips, these leaders would be bulletproof. Yet, as we're about to see, they were the exact ones driving their own institutions right off a cliff.
Picture this juxtaposition. On one hand, you have institutions that survived literal world wars, massive global depressions, and crazy historical financial crises. And on the other hand, you have those exact same impenetrable institutions collapsing under modern executive leadership. It is just mind-boggling that banks capable of weathering the absolute worst storms of the 20th century were ultimately defeated by the internal decision-making of modern CEOs.
So, here is our roadmap for today. We're going to look at the slow build of these massive failures, dive into the 2008 mortgage meltdown, fast forward to the 2023 interest rate shock, break down the actual anatomy of a collapse, and finally, wrap up with some actionable lessons for everyday investors. All right, part one, smart leaders, massive failures, and the slow build of a collapse. The absolute key thing to remember as we get into this is that financial ruin pretty much never happens overnight. It's a slow burn. It's the result of years of compounding decisions. You don't just wake up on a Tuesday and accidentally lose $100 billion. It starts quietly, with aggressive lending. Then it builds with poor risk management and way too much leverage. But the real kicker? It requires leadership to actively ignore the giant red flashing warning signs right in front of them. These four pillars of failure are the foundation of every single crisis we're about to look at. Which brings us to part two, 2008, the mortgage meltdown. Let's talk about the massive hubris of that era, starting with the biggest elephant in the room, Lehman Brothers, followed by Washington Mutual. Get this. For over 150 years, Lehman Brothers was a highly respected investment bank, a century and a half of history, just to be completely wiped out by toxic mortgage investments. Their CEO, Richard Fald, a guy they literally called the gorilla because he was so aggressively competitive, pushed Lehman deep into mortgage-backed securities during the housing boom. Everyone was making money hand over fist, and they genuinely believed the market would just go up forever. But, spoiler alert, housing prices fell, those investments tanked, and in September 2008, Lehman filed for bankruptcy. It's still the largest bankruptcy in U.S. history, and it was a massive catalyst for the whole global financial crisis. But hey, Lehman wasn't alone. Washington Mutual, or WAMU, was once America's largest savings and loan institution, and they fell right into the exact same trap. They expanded so rapidly into high-risk mortgages and completely turned a blind eye to the danger. When borrowers inevitably stopped making their payments, the losses piled up so insanely fast that federal regulators literally had to step in, seize the bank in 2008, and eventually sell it off for scraps to JP Chase, one of the biggest bank failures ever. Now let's fast forward a bit. We go through a massive 14-year stretch of historically low interest rates, from the 2008 collapses all the way up to 2023, and boom, we hit the collapse of Silicon Valley Bank. The economic era totally changed, right? But the crazy part is, the underlying executive hubris remained exactly the same.
So, part three, 2023, the interest rate shock. We're shifting gears from bad mortgages to the hidden dangers of interest rates, focusing on SVB and First Republic.
Silicon Valley Bank was the absolute go-to bank for tech startups. But the irony here is just wild. SVB wasn't taken down by shady, toxic assets. They were actually destroyed by supposedly safe government bonds. See, during those low-interest years we just talked about, SVB bought up a ton of long-term government bonds. But when interest rates suddenly shot up, the market value of those safe bonds absolutely plummeted. Tech founders got spooked, panicked, and started pulling their money out. SVB couldn't liquidate cash fast enough. It was a classic, old-school bank run that took down a massive institution in just days. They utterly mismanaged their interest rate risk. And the panic didn't stop there. It spread right over to First Republic Bank, like a contagion. Now, First Republic had this pristine reputation, catering to super wealthy clients. But post-SVB, those wealthy clients got nervous. Billions of dollars were yanked out in a matter of days. Other major banks tried to step in with emergency support, but it just wasn't enough to stop the bleeding. The confidence continued to tank until regulators stepped in, and once again, J.P. Morgan Chase acquired the remains. The crucial lesson here? In the banking world, confidence can vanish much, much faster than it's built, no matter how rich your clients are.
All right, Part 4, Anatomy of a Collapse. We've seen the historical stories, but why does this exact same pattern keep repeating itself over and over again?
Look at how these crashes compare. The mechanics are completely different, right? In 2008, it was toxic mortgages taking down Lehman and WAMU. In 2023, it was interest rate hikes and liquidity crunches crushing SVB and First Republic. The triggers changed, but the actual institutional collapse, practically identical.
Because underneath it all, the patterns are exactly the same. Pure overconfidence, way too much concentration of risk, super weak risk management, growing too fast without safety nets, and, honestly, the most fatal flaw of all, failing to prepare for changing economic conditions. It's this core belief that the good times will literally last forever. History tells us over and over again that markets move in cycles. Assuming a market will only ever go up is a surefire way to destroy a company.
And here's why this matters to all of us. When CEOs tank these billion-dollar banks, it's ordinary people who pay the price. The damage doesn't just stay in the boardroom. Regular employees lose their jobs. Everyday investors lose their savings. Small businesses suddenly can't get vital financing. Entire communities face massive economic disruption. Often, the government, meaning the taxpayers, has to step in to stabilize the whole system. The cost to everyday people is just staggering.
Which brings us to our final section, lessons for every investor. How do we take these massive institutional train wrecks and actually use their underlying truths to protect our own personal finances?
Listen, whether you're investing $100 or $100 million, these 5 rules are absolutely non-negotiable. Number 1, greed grows fastest when things are booming. Be incredibly wary when everyone seems to be winning easily. Number 2, every single investment carries risk, period. Don't ever assume past success guarantees future results. 3, diversify. It reduces your risk and protects you from putting all your eggs in one basket. 4, strong governance and risk management matter. Pay attention to the risk, not just the flashy returns. And finally, number 5, nobody is too big to fail. History proves even the biggest financial titans can and absolutely will collapse if they mismanage their risk.
At the end of the day, the story of America's biggest banking failures is really a story about leadership, risk, and accountability. In finance, just like in life, the greatest danger isn't what you can see, it's what you choose to ignore. So here's a thought to leave you with. As we eventually cycle into the next inevitable economic boom, what obvious warning signs are today's financial leaders choosing to ignore right now? It really makes you think, doesn't it? Thank you so much for hanging out with me for this explainer. If you found this breakdown of financial history valuable, hit that subscribe button so we can keep exploring the wild truths behind the world's biggest corporate events together. Catch you next time.